We've pushed it ahead by 18 months and then put where we are with CPI inflation on top of it. Money leads inflation. And you can see what this chart is saying. It is very likely that we are going to move into negative territory when it comes to inflation in 24 and 25. And we would not be surprised to see an overshoot here. And that will provoke a significant Fed reversal in policy.
Cathie Wood discusses the negative trend in money growth, which turned negative at the end of 2022 and continued throughout 2023. This trend is expected to lead to negative inflation rates in 2024 and 2025, potentially prompting a significant reversal in Federal Reserve policy. She anticipates that long-term interest rates will continue to decrease, potentially reaching as low as 2%. This expectation is based on the observed correlation between the metals to gold price index and long-term interest rates, which suggests a call for Federal Reserve easing. Wood also addresses the political debate around fiscal policy, particularly focusing on the U.S. federal debt, crossing over GDP for the first time in history, a situation exacerbated by the COVID-19 pandemic. She notes that while the debate is serious, it might not be as dire as many think if innovation drives problem-solving and turbocharges real GDP growth. She reflects on the historical context, comparing the current situation to the Reaganomics era, suggesting that similar supply-side policies could lead to significant economic growth and potentially reduce the debt-to-GDP ratio. Let us now get into the video as Cathie Wood goes all macro. Don't forget to like, subscribe, and drop your comments below.
Here is the chart that has really charged the political debate. You can see for the first time in history, our debt, our total public debt, this is federal debt, has crossed over. It did so. It was threatening to do so in the last 5 to 10 years. It did so decisively during COVID. Now, one thing about this is these are two different kinds of measures. Debt outstanding is a stock. It's an absolute number, level of debt. GDP is more of a flow. It is a measure of the goods and services produced in any year. And if we're dealing with a quarter, it's annualized. So again, any year. So different kinds of statistics. I think the debate is serious, but I don't think it is as serious as many think it is if we are right. That innovation solves problems, and we're going to go into a period, thanks to unbelievable amounts of innovation. You just heard about Bitcoin. We believe that real GDP growth is going to be turbocharged. So the 3% that we've seen on average over the last 100 years in real GDP growth, we think is going to be much higher going forward as these innovations hit critical mass, and all of them are moving into prime time. So, and then you can see on this next page what I mean. So this is public debt outstanding. So that purple line on the previous chart divided by GDP. And I do remember starting my career in the early days of the 80s. And oh my goodness, the debate was supercharged then as well. And what happened was Reaganomics or supply side policies did turbocharge growth in the 80s and 90s. And with a lag, we began to see the leveling out of this metric. We think there's going to be so much growth, so much more than even in the early 80s, that this line, debt outstanding to GDP, is going to come down fairly dramatically now that there is gridlock in Washington. And we believe that gridlock will be sustained during the next 5 to 10 years.
Given the anticipated shift to negative inflation, Wood suggests that there could be a significant reversal in Federal Reserve policy. This could involve easing measures to counteract deflationary pressures and stimulate economic growth. Wood believes that long-term interest rates are likely to continue their downward trend, potentially reaching as low as 2%. Wood expresses concern that the Federal Reserve's unanimous decisions in the past year may not have fully considered the red flags raised by various economic indicators from different Federal Reserve banks. She suggests that the Fed's focus on avoiding the reputational risk of letting the inflation genie out of the bottle may have led to an oversight of these indicators. Here,
the purple line is money growth. And you can see the money growth rate is negative, and it turned negative. This we've pushed money growth forward, but it turned negative at the end of 22 and was negative throughout 23. We've pushed it ahead by 18 months and then put where we are with CPI inflation on top of it. Money leads inflation. And you can see what this chart is saying. It is very likely that we are going to move into negative territory when it comes to inflation in 24 and 25. And we would not be surprised to see an overshoot here. And that will provoke a significant Fed reversal in policy. On this page, this is the yield curve. And the yield curve, the zero measure there, anything below is an inverted yield curve. And you can see we've had an inverted yield curve by this measure, which is the 10-year Treasury yield minus the 2-year Treasury yield, for 18 months, roughly. It's quite a long time, and it's reminiscent more of what went on in the late 70s, early 80s. And we ended up in 2 recessions in 1980 and 81 back then. So this would suggest that we're going into recession. The only consideration here, though, is if falling prices do ignite unit growth, meaning the unemployment rate doesn't go up too quickly, and corporations really start to understand that they can drive unit growth if they cut prices, that could be what this is signaling. We'll have to see. Right now, we do believe the higher probability is of recession. And then on this chart, just to give you a sense of the drama here, this is the number of consecutive days that the yield curve has been inverted. And you can see the 3 most serious recessions that we've had in post-World War II experience are the 73 to 75 recession, the 1980 to really, it was one big recession from 80 to 83. And then you can see where we are now. It's even more in terms of consecutive days than 08, 09. So if you were using this chart alone, you'd say, oh my goodness, what kind of recession is this going to be? Again, we've been through a rolling recession. I think that's partly what this chart is telling us. And we don't think the recession is going to be severe, but it is going to be something the Fed will have to address. Here is the Federal Reserve Bank of New York recession probability. It has been saying for quite some time that we're going into a recession. And in fact, late last year, we got to a level where we had only been in the early 80s before. So, but these votes at the Fed have been unanimous, which is kind of crazy, because each of the Federal Reserve banks has their own economist, economic department, and each one of these Federal Reserve banks, most of them, I would say, would tell you that their indicators were flashing red. And not just for the last few months, but for the last year. So I just think this Fed did not want to be saddled with letting the inflation genie out of the bottle. They didn't want that reputational risk. They were really thinking about themselves, and they weren't looking at these indicators.
The number of Americans filing new claims for jobless benefits dropped to a 2-month low last week, pointing to underlying labor market strength even as demand for workers is easing. With the report from the Labor Department on Thursday also showing the number of people on unemployment rolls remained elevated towards the end of December, financial markets continued to anticipate that the Federal Reserve would start cutting interest rates in March. The government reported on Wednesday that job openings fell to a near 3-year low in November. Labor market resilience is expected to again shield the economy from recession this year. The labor market is not too hot and not too cold at the moment, said Christopher Rupke, chief economist at FWD Bonds in New York. The total number of Americans on the jobless rolls receiving benefits remains elevated relative to prior year levels, but at the moment there is not enough unemployment to say the economy is on the downward slope to recession. Initial claims for state unemployment benefits dropped 18,000 to a seasonally adjusted 202,000 for the week ended December 30th, the lowest level since mid-October. Economists polled by Reuters had forecast 216,000 claims for the latest week. Claims data tend to be volatile around this time of year because of holidays. They have largely bounced around in the lower end of their 194,000 to 265,000 range for 2023. Unadjusted claims fell from 6,820 to 268,020 last week. Claims plunged by an estimated 7,572 in California and tumbled by 6,080 in Texas. The labor market is steadily cooling following 525 basis points worth of interest rate hikes from the Federal Reserve since March 2022. The unemployment rate, however, has remained below 4% as companies hoard workers following difficulties finding labor in the aftermath of the COVID-19 pandemic. The labor market is nowhere near a tipping point lower. That's excellent news for consumption and the economy at large, said Jamie Cox, managing partner at Harris Financial Group in Richmond, Virginia. Recession calls get trampled by a strong, employed consumer, and that's currently where things stand. Stocks on Wall Street were trading higher. The dollar fell against a basket of currencies. U.S. Treasury yields rose. Financial markets are betting the Fed will begin cutting interest rates as early as March. Minutes of the U.S. Central Bank's December 12, 13 policy meeting published on Wednesday showed officials viewed the labor market as remaining tight, but also continuing to come into better balance. They also showed that several participants noted the risk that, if labor demand were to weaken substantially further, the labor market could transition quickly from a gradual easing to a more abrupt downshift in conditions. The U.S. Central Bank held its policy rate steady in the current 5.25% to 5.50% range at last month's meeting, and policymakers signaled in new economic projections that the historic monetary policy tightening engineered over the last 2 years is at an end, and lower borrowing costs are coming in 2024. The number of people receiving benefits after an initial week of aid, a proxy for hiring, decreased 31,000 to 1.855 million during the week ending December 23rd, the claims report showed. The so-called continuing claims have mostly increased since mid-September, a trend blamed largely on difficulties adjusting the data for seasonal fluctuations after an unprecedented surge in filings early in the pandemic. Economists expect the distortion will be smoothed out when the government revises the data this year. What do you think about inflationary levels as we slowly settle into the new year? Share your thoughts with others in the comment section below, and don't hesitate to hit that like button, subscribe, and turn on notifications. Thanks for watching.
Hey Savvy Finance enthusiasts, massive shout out for being the heartbeat of Savvy Finance. Your support has been the wind beneath our wings, and we can't express our gratitude enough. Now buckle up because we've got an exclusive deal just for you. Ever wanted a slice of the action? We're offering a golden opportunity to own part of our YouTube channel's potential future revenue. This isn't just an investment, it's an invitation to be a part of our story. Investing means you're not just an investor, you will be a participant in the future of Savvy Finance. No cheesy lines, just a genuine call to embark on this journey together. But wait, there's more. Your mission, should you choose to accept it, become a Savvy ambassador. Share our videos on every platform: Facebook, Twitter, LinkedIn. Your shares amplify our visibility, potentially translating to more views and more YouTube revenue. Here's the kicker. If our viewership increases, we would not be just growing financially. We would be making a tangible impact by spreading valuable financial education. Now the icing on the cake. Invest and you'll score exclusive access to our private Savvy Finance Discord. Here you can chat with Savvy Finance, swap ideas with fellow investors, and be at the forefront of exciting developments. Click on the link below to register your Gigastar account. You can also find the link to my offering page in the description below. Get your Gigastar account ready, review the offering details, and let's embark on this thrilling venture together. To the incredible Savvy community, thank you for being the backbone of our success. Your journey is my journey, and together, we're creating waves. Cheers.